the top 10 most common trading mistakes, and then we'll go through each of them individually and take a look at them, look at them a little bit more specifically, so you can kind of check off in your own mind what kind of mistakes you make, and try to improve on them as well, and try to correct them so you can succeed like Michael Jordan. Number 10 is most retail traders think that trading is easy. Number 9, even though it's easy, retail traders tend to overcomplicate their trading and trading strategies. Number 8, retail traders don't have a mission statement or a game plan. I ask you all, you can raise your hand in your own home. Do you have a mission statement or a game plan? If you don't, maybe that may be one of the problems with your trading, if you're having a problem with your trading. So I'm going to give you my mission statement, my game plan, and hopefully you will use that as well. Number 7, most retail traders rely too much on fundamentals. Number 6, most retail traders give the oscillators too much credit in your trading. Probably some of you are probably thinking, what is this guy talking about? Doesn't want to focus on fundamentals, doesn't want to focus on oscillators like the RSI and stochastics. Well, I'll give you some reasons why you shouldn't, why I think it is a mistake from a retail trader's perspective, and why it can hurt your account value. Number 5, most retail traders don't define risk, or they take too much risk. Number 4, most retail traders, if you target level on your trades, that's target a place where you're going to go in the trade that you put on, that level is too far away oftentimes, and as a result you never get to it. Number 3, most retail traders exit without a reason. We do all this work to enter a trade, and we have all these reasons to enter a trade in most cases, but a lot of times retail traders don't have a reason to exit, and as a result of that, you don't tend to trade trends very well. And trends are where you make the most amount of money with the least amount of risk, believe it or not. You can also lose the most, in fact, you do lose the most amount of money when you trade against the trend, and that certainly is not our goal as a trader, is to lose the most amount of money. Our goal and our mission statement is to make the most amount of money. And number 2, most retail traders don't anticipate trends. There are ways you can anticipate trends. I don't have a crystal ball in front of me. I don't know it all, but I do know that there are clues that the market gives you, allows you to anticipate a trend. And the most common trading mistake that most retail traders do is they against the trend. You lose money. Choppy moving markets that move up and down. Most people have that buy low, sell high mentality down pat, but to stay on a trend, it's very difficult for a lot of traders out there. But even though it's easy, through number 10, they tend to overcomplicate your trading. It's human nature. It's human nature to think that the more you know, the better you will become. But it's not necessarily true in trading. Now, I'm not saying that knowledge isn't good. You should read Ed's book. You should read my book. Other traders' books, and try to educate yourself on what is out there and what is the proper way to look at the market. But after you do that, you have to downshift and focus on what is important. What is going to make you money as a trader, and that is what retail traders tend to make a mistake, is they think that, well, if they just pile on all these different ideas into their charts, they will have the answer. And I put up this chart here because if any of you out there has something that looks like this, you're probably overcomplicating your trading. Now, this is obviously maybe a little bit of an exaggeration, but it's not uncommon for people to have RSIs and MACDs or stochastics. It's not uncommon to have Bollinger Bands. This colored area is an Ichimoku cloud. We have trend lines. We have Fibonacci retracements in here. We have other moving average lines in there, the red and the green line, and all of that goes into your mind, and it tends to overcomplicate you're thinking. You see bullish signs, you see bearish signs, and what does that do to your mind? It overcomplicates it. It makes you more fearful, and fear is a trader's worst enemy. You have to, in my book, you have to steer clear of fear. It's a hokey type of little rhyme that I use, but most traders, if you have fear, you're not going to trade well. Think of anything that you have fear in, and you're not going to do well in it. Michael Jordan doesn't have fear taking that last shot. So if he did, he would not have lasted as long as he has. So he doesn't have that fear. He has that. He steers clear of fear, and you as a trader have to steer clear as well. That same chart. This is how my chart looks. Just to give you an idea, I have a trend line in there. I have two moving averages. I use Fibonacci retracement levels, and those are the three tools that I use. And I'll analyze a market in this very simplistic way. I have points 1 and 2 here, and that allows me to draw a trend line. And then this blue line right here, this is my 100 bar moving average, and this is an hourly chart, so this is a 100-hour moving average. And that's my trigger. If the price moves above the 100-hour moving average, it gives me a buy signal. Now, I also, because I drew this trend line here, the market does come down, and this gives me a level to buy against. Why? Because I have the trend line support there, and successful traders will trade around what I call these borderline levels, and I do too. These are levels where it's bullish on one side and bearish on the other side. And in this case, we have the trend line coming up, and a trader who would buy against this level would simply put your risk below probably this 38.2% retracement of this move to the upside here. This is another one of the tools that I use. It's one of the three tools that I use. And so anyone who bought against the trend line would put their stop just 10 or 15 pips below the 129.63 level. And if you're right and the market moves back above the 100-bar moving average, you get to benefit from this move to the upside. Is this complicated? No. Is it simple? No. Is it simple? Yes, it is simple. I got my words mixed up there. It's very, you could use these, you can simplify your trading by using just, three simple tools: trend line, moving averages, this is 100, this is a 200, and the Fibonacci retracements. So what happens as we progress along this chart, we come back down to the 100-bar moving average, we hold that support, break below it, and where do we come down to? The trend line once again. We come and test the trend line. Does this give you another buying opportunity? Of course it does. Look what we're against here as well. This old high right here. So your risk on this trade is, if we move below that old high right there. This is the euro dollar. This happens often in the market. Market finds support against that level, moves back above the 100, confirms move back up to the upside, and we're up back trading around the 132.31 level from the 131.50-ish type level, or even below that level, about the 30 level. So we've moved another 100 pips to the upside, come back down again, move down, test the line again, use 100, test the line again, move back up again, and at 7, finally we move below the 100, and the trend line converge at the same point, and the market starts its corrective move to the downside. This is the FOMC meeting announcement where the market moves sharply higher, and what happens here, the price ends up in what I call in between the goalposts. This is where the price is in between the 100-hour simple moving average. This is an hourly chart, and the 200-hour moving average. This is indicating that the market is non-trending, or it's confused. It doesn't know which way it wants to go. Either we're going to break to the upside or we're going to break to the downside. When it breaks to the downside, I anticipate a move to the downside. Why? Because your risk is limited. Your risk is if the market moves above the 100-hour moving average, plus the market is unsure at this point, but it wants to move away from this area and start its move to the downside, and that's what happens. It starts trend to the downside. So everything in this chart is very simple. It's utilizing three different tools. It's not overcomplicated. My mind is clear, and I think you, as a trader, can also use this strategy and clear your mind of all the clutter, and take the complication out of your trading. Keep it simple so that you can steer clear of fear.